Alright, we're going to calculate the proformas, and using the proformas we'll do free cash flow to firm and then find the value of the firm. And just to be clear, I've added 2011, 2012 for historical. So in that case, I can just type the numbers in because that's history, that's not going to change. And 2013 forward are going to be my projections. So let's start with sales. Sales we're going to say is going to grow at 10%. So 1 plus this sales growth rate. Lock that down. Cost of goods sold is going to be a certain percentage of sales. Lock that down. Gross profit. SG&A expenses is going to be a certain percentage of sales. Fixed expense we're going to leave as 0. And just have it, if we wanted to put fixed expense in, we could. Depreciation expense is going to be 10% of gross fixed assets, but it's gross fixed assets throughout the year. Remember, balance sheet is a snapshot at the end of the year, so I need to know the entire years. So EBIT would be this, the gross, not plus, the gross minus the different expenses. So interest earned is a good way to think about what I'm doing with this average here. I'm going to earn 8% on the cash I have in the bank, right? But how much cash do I have in the bank in 2013? Well, at the end of 2012 I had $800. At the end of 2013 I'll have some number here, but now it's 0. What I really need to know is how much I had in the bank each day, right? But I don't know that. I can just get an estimate and just assume that cash was spent in a uniform manner throughout the year, and that would be my cash. Same thing for the interest expense, the interest rate on debt. Make sure I lock that down, times the average debt for the year, last year's, plus this year's, divided by 2. So this will be that plus the interest earned minus the interest expense. Taxes are 40% of my taxable income. And there's my net income. Now I can go ahead and take this, copy it all the way across, and there's my income statement, and each one of them is wrong because it depends on things in the balance sheet that we don't have yet. So the cash is going to be my plug figure, and we'll see a problem with that in just a second, but the cash is going to be the plug figure, which means it makes the balance sheet balance. So total liabilities and equity minus my net fixed minus my current, and for valuation purposes I'm separating out current assets from cash. Current assets are going to be a percent of sales. Lock that down. Gross fixed assets are accumulated depreciation plus net. Accumulated depreciation is last year's accumulated plus the depreciation expense. Net fixed assets are percent of sales. Total assets are going to be net plus current plus cash. Okay, I have that side of the balance sheet. Copied it all the way over. See, these are all zeros because I have nothing for my liabilities and equity, right? So I have to put that in. So my current assets, current liabilities are percent of sales. My debt, I know from talking to management, the plan is to pay down the debt according to the following schedule, and then they'll have no debt after that. So this is not something that we necessarily have to project and guess at. This is what management tells us they're going to do. Go ahead and copy that over as well. They also say our stock, we're not going to issue any stock, we're not going to repurchase any stock, so it's going to stay like that. Retained earnings for last year's retained earnings plus the amount of retain this year, which is my net income, times 1 minus my payout ratio, and my total liabilities and equity. Just sum this up right here, and now we can copy these two numbers over. Now, one thing you might want to do when you're doing this is have some conditional formatting, and that conditional formatting, which I won't do here, but would make this be would show when this is going to be a negative number, and that's what we have to worry about right here, is you run out of cash. So if you run out of cash, you obviously are going to need to borrow money or issue stock. So all this just is a brief point of using cash as a plug figure is fine, but if you have a negative number like we do here, we're going to have to issue some more debt, you know. So that's just one of the little things you have to keep an eye on when you're doing this. We'll keep it for now, negative cash, and not worry about it. And we'll just think of that cash as negative cash as short-term borrowing. We have a revolving line of credit at the bank. We'll just borrow the money. We can think of it that way. Net income. For free cash flow to the firm, we need to get the cash flow to the firm. Think what it means. So net income, but you also have non-cash charges, in our case depreciation. You want to add those back. So we add back those depreciation expenses. I should be doing this one step at a time. Net income right here. We want to add back the depreciation expense. The current assets and current liabilities, these two, this is our net working capital. If we have to put working capital into the firm, we need to subtract that out because that's taking away from our profitability. So the way that works is we need to subtract net working capital, which is, let me type it here. It's going to be minus the change in current assets minus the change in current liabilities, right? I have to. So we're going to do that calculation, which means we're going to have the current assets from last year minus the current assets from this year. For current liabilities, it's going to be current liabilities of this year minus current liabilities of last year. Our gross fixed assets is going to be fixed assets from last year minus fixed assets from this year. The interest on cash, we're going to subtract the interest we get on cash, and we're going to add back the interest we paid in interest expense. The reason for that, this net income number, right? We've already subtracted the interest expense, but I'm looking at the free cash flow to the entire firm, which means to the guys who borrowed, you know, to the debt holders as well. So I'm putting that back in, and I treat the interest earned as essentially as negative debt. So let me copy over this. This is just summing that up. I can copy all these over. Actually, I'll put that border back the way I had it. Copy all that over. And I got rid of this double border. I'm going to put that back. Okay, so those are my free cash flow to the firm. To do the valuation, I might just recopy these. Not at this point. I need the weighted average cost of capital, which would be something like maybe 14%. A terminal growth rate, something like 6%. The free cash flow, here are my free cash flows. The discounted, I'm not going to have a terminal value here, but I want to discount each one of these. at 1 plus the weighted average cost of capital. I'll raise that to the power of the year. I'm going to put the year right here. So this is year 1. I'm going, oh, I don't want to do ones. I want to do, make Excel recognize what I'm trying to do here. I'll go for these 10 years. Do my discounted value. And my present value of the cash flows is going to be the sum of all these numbers. But I need my terminal cash flow, my terminal, not cash flow, my terminal value, which is going to be the free cash flow from year 10 times 1 plus the terminal growth rate divided by K minus G. Same thing that you've done in the non-constant growth model. That's the present value of those future cash flows. Excess cash, here's the debatable part. I'm going to put in my total cash from 2013. I don't know if that's right or not. Right? I need to put in the cash they don't need. I'm just valuing all the cash. I'm doing that so you can see that you need to do something with the cash, and that's very difficult to know exactly what there. The debt, I need the market value of the debt. Let's just say it's the same thing as, actually I put the wrong cash in, didn't I? Cash today. And the market value of the debt, we'll say currently is 320, close enough to the book value. So the equity value is the firm value minus the equity value, minus the debt value. And shares outstanding, we can look up, say there's 750. So that's the share price. One thing you would want to be able to do with this is say, you know what, I'm not sure about these numbers. So I could have these are my weighted average cost of capital right here. And then my different terminal growth rates. Right there. And I'll get this formatted correctly. And now I can just do insert. Sorry, I'm on the wrong spot. What if analysis, data table, the row cell, what's in the row, whack, the column is the terminal growth, click OK, format all this stuff, and then from there you know how to do the conditional formatting, so that's quick and dirty valuation. Note it took under 15 minutes to do all of that. So I think you should be able to do that whole thing in no more than 30 minutes.